early warning system?
Sure. Hi, my name is Eugene Nedov, and I work this year at the Risk Center as a researcher, and also I worked at FNA, Financial Network Analytics. It's a startup company that explores network effects and in different areas such as correlations and payments and other areas. So I will illustrate now how we can use this system as an early warning system for different scenarios that my colleagues discussed before. Let me just take us through it. So the main point is that we know that we go through financial crisis, and the preparedness for financial crises is key. So if you can analyze the impacts and you can know in advance what's coming up, then you can position yourself appropriately. So we'll explore some leading indicators and how by balancing your portfolio in the right way and staying away from certain asset classes, you can dampen the impact and position yourself. Okay, so these are the four scenarios that we've talked about: the global property crash, the Eurozone meltdown, high inflation world, and dollar deposed. And the system of leading indicators that we've developed applies to all of these four scenarios and gives you between sometimes a quarter to a year early warning, sometimes 3 quarters to a year early warning. Okay, so the case study that I'll focus on is the asset bubble in properties, in particular the US asset bubble in 2008. And we will pick some indicators in building construction and see how this provides us a warning about 3 to 4 quarters ahead of the actual events. Okay, so I mentioned FNA, that's the tool I'll be using. And we will go through different phases of housing crisis, where it starts with bubble emergence and then goes through tapering, bust, goes into bottoming, and then possibly re-emergence currently. So there are a lot of news, obviously, about different fears of housing market crashes in China and in Brazil and Indonesia, etc. So we think about it all the time. And if we look at the indicators such as house price to income ratio or house price to rental ratio and map different countries on it, we can see that there is quite a lot of countries in the bubble, especially the ones you see at the right top corner: China, Brazil, and somewhat lower UK. So let's go through this most recent famous case study, which also happened to bring the whole financial system down with itself. And I will look at the indicators: building permits, homes started, homes completed, new houses for sale, home price index, and home loans. So this is the timeline of the crisis. In 2005, we see some foreclosures starting. 2006, there is a slowdown and construction index is down 40%. 2007, the prices started falling, new century files for bankruptcy. 2008 is where it really all accumulates, and there is a sharp fall in the equity index in the US. Bear Stearns and Lehman go out of business. And by 2009, the situation is so bad that the government has to institute a program to save things. So this is our timeline, and the crash is about the end of 2008 and 9. The sharp is sort of the shock that shocked everything and caused the meltdown in the financial system. Whereas these are the phases of the housing bubble underneath. And in between, you can see some signals that I'll explain in detail now, where we see this movement starting already in the beginning of 2006. So just a couple of words what this is. We map correlation structures in FNA using a concept called minimal spanning tree, which reduces information in correlation systems and just shows the skeleton of the most important connections. So the assets here, in this display, these are house price indices by state in the United States. And the links, the length is proportional to the correlation. So the closer, the stronger is the correlation. And things that are in the middle are so-called systemic risk. Things that are in the periphery are less important and influence the system less. And we also looked at the outliers from the normal distribution of returns. And these dark green dots, it means that they are way out of the normal distribution prediction with 95% confidence. So 2003, we see this bubble emerging, and lots of outliers in green. So there is growth in home prices in the States, and they cluster in some particular areas, as you can see. Then 2004, it gets even stronger. Now you see this is across the entire system, even faster growth, more outliers, and now going to the states where you usually don't see so much constructions like Nevada, etc. So this is, the whole tree is infected, if you want, with this excessive growth at that point. Now, 2006, we see a reversal of the situation, and now we look at the construction indicators that I mentioned, the building started and building permits. And you see it's all in red. So in red, it means that it's a negative growth now. It's also an outlier, and there is quite a few of them, and they're in building permits in pretty big part of the system here. So this is a bit more detailed. The building permits sharply go down in Q1 of 2006 with really large outliers. Now, if we project that picture through the entire timeline, we see that also quite clearly. This is the 95% confidence band. This is where it kind of falls off the wagon in 2006, and it stays underneath it for quite some time. And then the system goes into this increased volatility state. It's a regime change, essentially. So the correlation network itself it is starting to grow tighter, and systemic risk is an increase. Then 2007, it just persistent, so it gives you a confirmation of the warning. There are outliers now in homes completed, and the downward move continues. So you see the consistency of the signal. And now we come to the bust point, which is 2008. Where the systemic risk now increased quite a bit. You see from 20%, it's 38 now. And the length of the tree, which measures how tightly things are correlated, is from 9 down to 7. And you can see this R survival shows you the structural changes in correlation system. It's also an increase, so the system is changing quite a lot. And then the bottoming is 2009. That's really where everything just plummeted, and you see all these negative outliers and the house price indices across the states. And the network is really compressed now. It's all behaving as a one factor. We can see, okay, I think this is just more of the same point here. But the bottom line is that studying the correlation structure without you looking at anything else, it just signals changes quite a bit ahead of the actual sharp fall. So you have a warning, in this case, over a year before the critical event takes place. So if you monitor how the correlation is growing or contracting and the outliers in it and how it spreads out, you can get an early warning view. So the same system will also apply to the Eurozone debt crisis. where we took some major government bonds, and they are the assets here, and these are the correlations between government bonds. And I'll just briefly say that in 2004, 2005, all the European sovereign bonds are clustered together. So you can see it's a very tight cluster, very correlated. And the outliers are all showing up. It's the bonds are appreciating in value. Whereas by 2009, before the system kind of exploded in 2010, but in 2009 you see how the structure changes, very stretched out. There is clear periphery branch with Greece on the outside of it, and Italy, Portugal, and Spain in there, and then the Central and Northern European countries are on the other side of the spectrum, and this is quite a bit ahead of the actual spread divergence. And then the same system I was trying for De-Americanization to see the rise of renminbi, and this picture shows how the crisis in US in 2009, where US started having this negative trade balances and decreased investment. So that decrease translated into increase in deposits in renminbi and cross-border trades in renminbi. So it went towards Chinese economy at the time. And the last one is on inflation. So we're trying to monitor inflation. The most recent fear of the outbreak of inflation was in 2008, when there was this commodity boom for some time. And you can see that at the time there is a boom in oil and food prices, and there is a sharp decrease in consumer confidence. So we also included velocity of circulation as one of the indicators, home prices, imports, monetary base. So that's potentially a set of indicators to monitor and just see how that correlations between them change, evolve with time, and the outliers in their distribution to see if something else is coming up. Okay. I think that's it. Okay. Yeah. So now, if you have questions, feel free to ask.